Year. Happy New Year. And we're kicking off launching our first online class of the year. So give a little intro to it. You can see what we're talking about. And that will be managing a 10K weekly portfolio in 2017. One other thing I just mentioned before we get started here, on the front page I've got about 10, 11 different cities listed that I'm going to be doing free seminars over the next 3, 4, 5 months. If you live near one of them and you'd like to come, it'd be great to see you. We'll be doing 3-hour seminars, and they'll be good seminars. We do a lot of meat. I don't really do infomercials. We just teach, and it'd be great to meet you. So check those out. If there's one near you, they're free. Just sign up with limited space, and it'd be great to see you. All right. Well, as far as today, let's jump in here. So a couple bits of information. This is for educational purposes here. As you see the disclaimer. And this is just a little bit of information just so we can get that going. Kind of a tentative class schedule for the first online class we'll be teaching for this year. Today is kind of an intro to it. We'll go over some things, and that's what today is. But you can see here the first class starts a week from today, Jan 11th. Class number 1. These are general topics. Greeks of weekly trades, January 13th. Class number 2, how we construct the portfolio. And then number 3, you can see the dates. Iron condors, calendars, and butterflies. I'll be teaching every class except these 2. I'll be out in California doing seminars. Mark Fenton, who works with me, will be teaching this one, and he does this trade very effectively. And at the money broken wing butterfly, I'll be talking through that. And then Jay Bailey will be doing this class, the 9-day rut calendar, something that he came up with maybe 3 years ago, and is one of the more effective trades that we do in Sheridan mentoring. And then I'll be talking double diagonals, insurance, miscellaneous stuff. I may tweak the schedule a little bit as I see fit, but that's a general overview, so it starts next week. Class information, the same as all of ours. These are about 8 to 10-hour classes. It's $397. We meet Mondays and Wednesdays at 1 Central. The minimum for each class is an hour. Sometimes I've gone 2 hours. It all depends, but minimum of an hour, so 8 to 10 hours live on the material. All classes are recorded and archived. You can watch them 6 months after the class or whenever. Some of the nice features are the Q&A. Whether you watch it recorded or live, you can ask questions. We'll have a class page. You can send questions in, and I'll always answer them. So it's great like that. Here's your first class, and you'll be able to sign up halfway through this class. The sign up link will be on there. You can go to Sheridan Mentoring and sign up. And one of the great things when we do these classes, we try to make them practical. There's some teaching part, but every class, basically, I'm doing a live trade and we're following it through so you can see the practical. Okay, here's the guidelines on the strategy Dan's talking about, the risk management, and I'm gonna trade through it. So I will, there's not many classes, live classes that I've done, online classes over the last 2-3 years that I have not done a live trade. So they're extremely practical and focused to help you be able to do this. All right. If you have any questions, you could let me know on that. You could email me, Dan@SheridanMentoring.com. The class starts a week from today at 1 o'clock. So if you sign up before them. All right. So why weekly trades? How many of you trade weekly trades? And when I mean weekly trades, I'm talking about trades that you put on that expire in 1 to 10 days. How many on a regular basis put on trades that expire in 1 to 10 days, weekly or short-term trades. Rick, who else? On a regular basis, how many of you put on at least one trade, whether it be a calendar or credit spread, whatever it is? So some do, some not so much lately. So what are some reasons why weekly trades? Less capital than maybe doing a 30-day trade or a 60-day trade, less capital committed, and to get higher yields, right? Why do I like these short-term trades? Because I can be in them less days. Whereas, I might put a 40-day trade on, 40-day duration trade, and I might be in it. I'm in it every day, right? I'm in these. Whereas I might put a 7-day trade on it, and I'm only in it 2 days when they work out, and I'm out of the trade for 3, 4, 5 days. Rick says he liked. We did a one in the Sheridan Mentoring TV, SOM TV, which meets Tuesdays and Thursdays at 1 Central, and it's free. SOM TV. We do live trades almost every class when I'm doing it, and we've been doing these one-day butterflies, and those can work well too. Weekly trades, I like them for students because it makes you trade more, right? You're trading every week, and so you learn more. Less volatility risk. When you're doing trades that expire in 7 to 8 days, price risk is really the big thing you have to deal with, whereas volatility risk is not anywhere near as important on a 7-day trade as it would be a 50-day trade. So those are some of the pluses. The biggest negative is you got to be careful, price risk. Excuse me. Excuse me. Price risk is the big thing. So it's really, you're looking at time decay. You get this big time decay, big decay on these trades. Our philosophy here at Sheridan Mentoring and weekly trades is this. Thank you. Consistency. We put these on every week, right? Where I'm not saying that there's not a few isolated times during the year, maybe a Brexit or an election where maybe a week I might sit out, right? Because with weekly trades, I can put them on every week, so that's 52 trades. But our philosophy is if I'm going to put like a 9-day trade on, I put it on today, Wednesday, and expires a week from Friday. I'd call that a 9-day trade, whether it's a calendar, butterfly, iron condor, credit spread, but we're on every Wednesday. Rain or shine, right? If Jim Cramer says don't play, I'm playing. If Fibonacci and Gubernacci and Elliott Wave say don't play, I'm playing, right? Now, is there a couple times a year if there's a huge event coming and I'm a little concerned? Yeah, but let's face it. If you guys read the Wall Street and read blogs and read news, is there a reason to stay out of the market all the time? Could you find a reason to stay out of the market all the time? Yes or no? Could you find a reason to stay out of the market all the time? Of course you can, right? Of course you can. So our philosophy on weekly trades, put them on. So again, if I'm putting a trade on today on a Wednesday and it expires a week from Friday, that's a 9-day trade. Rigid plan. So rigid plan meaning I have a profit target on the trade and I have a maximum loss, and so there's no playing around, right? How many of you play around like when you get that? How many of you have a great, how many of you can answer me and say, Dan, here's how I expect to make money, but if I asked you, what are you going to do if it goes against you, that might not be as good of an answer. You don't have to answer. But most of us have a plan what we're going to do when we make our money. It's like if you win the lotto, what are you going to do? But most of us don't have a plan when the trade goes against you. So we have a rigid plan of what we're trying to make and what the most we're willing to lose. Tight risk management. Again, that kind of goes along with this one. tight risk management, we're not leaving it up to the market. We have our plans. Very little adjustments. When you get to 1 to 7 or 1 to 10 day trades, I don't do as much adjusting or tweaking as I do if it was a 40 or 50 day trade. There's just not as much time left. But a lot of times I may limit my trades to one adjustment. Again, usually these are non-directional trades, and I let the theta work. Right there, I'm trying to capture that big theta, that big decay that happens the last week, and that's it, right? And I think so when we're playing, it's a 52-week game. So if you're doing whether it be calendars or butterflies, it might be, hey, you might have a win-loss record of you win 42 and you lose 10, right? Or you win 35 and you lose 17, right? And that's how it's going to look, right? Something like that. That's what you're looking for. But you play every week. We don't know which week is going to be bad or good, but we can control. You can control the things you can't control. So we focus. You can control. You focus on the risk management. Robert and Mike can spend all day long figuring out which way the market's going to go, and they still don't know, right? So focus on your trades. So here's an SPX price chart for 2016. Really, it's 2015. And then starting here about 2016, right? And it's the price chart. And focusing on from like July through the election, we're in about a 100-point range on the SPX from July through the election, and then, and that's a lot of these stable periods. You had a really long one in 2015. You had a couple good ones in 2016. Here's March through June, and these are all where you have 100 points or less range in the SPX. But some of the periods since the election, you've basically gone from 2,100 to a high of 2,277. So when you start getting near 200-point range, moved about 177 points since the election, that's a little bumpier. And right now, we're still trying to find the range, right? I don't know any more than you do if we're going up or down, but it's a little more, even though we're a low volatility environment, VIX is 12 as of today, it's a little more bumpy because there's more of a range. We're not really in a range like we were from July through the election, right? So what does that mean for you guys? It means that we want to, it is a little harder on income trades, and I think this period of time than this for a couple of reasons. You don't have much premium, and you've got a wider range. We're not really in. We're trying to get this new range, right? So it might be a little bit bumpy going forward, but you still play. All right. So let's talk a little bit some of the strategies. Get a little feel of some of the strategies we'll be talking about during the class, Iron Condors, and just talk at least a little bit on the Greeks. We'll talk much more about that next week, but a little more on the Greeks. And you can see here's an example I looked at today with SPX. Here's an Iron Condor. How many people have done an Iron Condor 9 days or less, where it expires in 9 days or less, a short term? Has anybody in here done an Iron Condor, like a weekly strategy that expires in 1 to 9 days? Okay, some of you have. Great. Rick says he did an Iron Condor for earnings for 1 day. Someone said it's not worth the premium. And again, I'm a big proponent for, how many of you have the mindset for whatever reason that you only sell premium when the VIX is higher? How many of you, maybe through your training or your perception or through your education, like the VIX higher, like to sell are more, hey, I sell premium when the volatilities are higher? How many are of that mindset that, okay, I'm a little different, right? I for many reasons, but I'm not a big, I think the best time to sell premium is all the time, right? If you look at 2016, 8 months were really quiet. We had a less than 100-point range in the SPX, and VIX was 15 or 16 or lower, and it was one of the best times to sell income in the history of civilization since Julius Caesar came to Chicago, right? So I don't look at, I think, the best times to sell premium are all the time, right? But if you also think about, if you want high volatility, right, the only time you're getting high volatility is either around earnings or the markets got hammered, right? Agree? And is that great opportunity? So anyways, so that's what I found works, if you're going to make a living doing this, sell premium all the time. Now, I will say this. Do we tweak these trades a little bit when we're selling premium or doing an iron condor when the VIX is 12 and SPX is 2267 like it is today? Yes, maybe a little bit. So let's talk about some of the idiosyncrasies of an iron condor. Now, here's an example I took today. I'll call this a 9-day iron condor. So I'm putting it on Wednesday today, and the expiration will be January 13th. That's a week from Friday. So that would be about a 9-day iron condor. Let me just say this. It's hard. I watch the chat. It's some stuff I want to let go, and some I can't, right? Like Chris says, everyone likes high vol when selling. Well, I don't. Let me ask you a question. So what would get the VIX up to 20 today? What would get the VIX up to 20 today? VIX is at 12. What would get it up to 20? Give me an answer. We want high vol. We all love high vol. What's it going to do? Right? We need the SPX to drop 40 points or something. So SPX drops 40 points, right? And then the VIX goes to 20, and now we all look at this and say, wow, I'm not even going to eat dinner tonight. The market looks like it's going to crash, but this is just phenomenal. The volatility is high. We just need to sell this stuff. Really? Really? Really, really, really? So VIX goes up to 20, vols are high, and you're so excited. Everyone else is scared, but you're just sell it. You say, Chris, what are you thinking? Just sell it, right? But Chris, we could be down another 50 tomorrow or up 30. Just sell it, right? What's the point? The point is, usually when the volatility goes high, other than earnings, it's because the market got stinking beat up. And if the market drops 100 and we rebound up 30 points and the volatility comes out, what you generally lose on the, or what you make on the volatility, you lose on the price movement. So it's not that you can't make money by selling high volatility, but I think it's looking at the big picture, isn't it? And questioning why. We can't just, anyways. So SPX 2267 and VIX is 12, right? So it's a very low vol environment. We're doing an iron condor here. So we're looking, our class is going to be how to manage a 10K portfolio. So, on a 10K portfolio, I might be doing 3 iron condors. So in this example, I'm selling the 2305 calls and buying the 2315 calls. So here's my short. This is the expiration graph on the iron condor. I'm selling the 2305s. On the put side, I'm selling the 22.25s, right? And my long put is 22.15, and my long call is 23.15. So when I look at this trade, and the credit is $1.60. So in this, because the vols are lower, I'm selling a little bit higher delta than I normally would to get a little more credit. And so my credit is $1.60. So if I'm doing a 10 wide credit spread on either side, my risk is $1,000 per credit spread. And so if I do 3 spreads, my risk is $3,000 minus, so for each spread, your risk is going to be $1,000 minus $160, so it'd be $840 times 3, be about $25.20 would be my capital on the trade. Yeah, so I'm putting, and it could vary, but I'm putting, $2,000 to $3,000 into this trade on a 10 grand account. And so the Greeks of this, you can see, my deltas will be short 2 on this position. This is a $2,500 position. Here's my negative gamma. My theta is positive 43. My vega is short 110. So that's the biggest difference between a 9-day trade and a 30-day trade, or a 9-day iron condor and a 30 or 50-day. Your theta is going to be a much bigger part, a bigger ratio of theta to vega. Whereas if this were a 50-day trade, your vega might be 160 short, but your theta might be 8 or 12. Anyways, so that's your trade. You have, and that's the key here. I try to keep the deltas pretty close to neutral on these income trades and let the theta work for me. And that's it. And that's what we'll be, we'll be spending at least a session and a half on, the weekly iron condor, how we trade it, the plan, how to adjust and everything. I'll put on one live trade after I'm done here today, and we'll follow up on next week. But this will be one of the trades we'll use. We have some folk in our community that successfully we teach a 4-day iron condor. So we'll touch on that some in the next couple of weeks. So, but this is an iron condor. It's a very short-term trade, looking to be in the trade maybe 2 or 3 days. So SPX was 22.67 today when I looked at this. So our short call is about 38 points out of the money, and our short put is 42 points out of the money. So just a few deltas short against your short vega, which normally I'd like to be a little bit, especially in a very low volatility environment like we are. So we're going to talk about, with the iron condor during the class, a couple different ways to trade this, look at adjustments, and we'll be putting on some live trades and demonstrating how we do this. Carolyn says, these things can move fast. Do you recommend trading weeklies if you have a full-time job and can't watch the screen? Well, a good question, Carolyn. I think, they can move fast. I think it's not so much, we have plenty of students that have full-time jobs and trade weeklies. So what's the answer? If you're going to, obviously, it's, even if you trade strategies that has 40 days duration and you can't watch the screen, you need to have risk management in. So people would have orders in before they go to work, either to take the trade off for a profit or a loss, or to do an adjustment. So, it's wonderful with a lot of these brokerage firms, the technology that you would put orders in. So really, a lot of the weeklies I'm doing less adjusting. So you can have your orders in when you want to get out of it. But you do need to have some time, I think, to look at these things, especially if it gets if you need to make an adjustment. But you can't, again, technology is wonderful these days. You can automate it that if SPX gets a certain point, you could take off the bad side of an iron condor, right? You can do that. So really the answer, Carolyn, more than anything, if you're trading weeklies, can they move fast at times? Well, yeah. But the bigger thing is getting to understand your brokerage platform and knowing how to put orders in, so before you go to work in the morning, just have your orders in, right? Like Nick is saying, and Rick, yeah. All right, let's go to strategy number 2. This is another strategy we teach. It's very effective, butterfly. Again, SPX, it looks similar to a calendar in that, this is the expiration graph. Very similar to a calendar. The difference is one benefits if the volatility goes down. That's a butterfly because you're selling the at-the-money calls and you're buying, or you're selling more of an at-the-money option and you're buying, in this particular case, this is an all-call butterfly. You're buying an in-the-money and you're buying out-of-the-money options that have less time premium. You're selling more time premium. And so if the volatility goes down, you'll benefit more because you're selling the ones with more time premium. So in this example, SPX was 22.65 actually, and we sold close to at the money. We sold the 22.70s, sell 8, buy 4 of the 22.50s. Same expiration as the other one, folks. Jan 13 expires a week from Friday. And then we're buying the 22.90. So this was, our short was 22.70. Our upper long is 22.90. This is all calls. And our lower long is 22.50. The cost of this trade is about $5.15, about $5. So if I did it 4 times, 4 by 8 by 4, 1 by 2 by 1 is 1 time, 2 by 4 by 2 is 2 times, 3 by 6 by 3 is 3 times, 4 by 8 by 4 is 4 times. So 4 times this would be your margin or risk, or about 2,000. So I'm trying to use maybe 3 strategies on my 10K portfolio and want to use up about $800 to $8,500 of cash. Again, you can see the big theta compared to the short vega, right? And this number is going to grow each day. So you have that nice big positive theta number. And really, on a margin of $2,000, we're looking to make about, maybe 10%, 8 to 10%. So $160 to $200, that's only a couple days of theta, and this number grows exponentially as we go on. So, you're really looking to be in these trades a couple days. Now, again, because we're in a very low volatility environment, you have your break-evens are about 15 points up and down from the short strike. You say, that doesn't seem like a lot. Well, if I'm going to trade 1 to 2 days, that's pretty good. That's not bad, right? Meaning that even though this is a 9-day trade, I'm not holding this till expiration. So this is a butterfly, and Jay Bailey will be speaking on, or Mark Fenton will be speaking on this. I'll be speaking on some of the successful methodologies we've used in the past and the present on these things and talk adjustments, and we'll go through live examples of this to help you. I'm only doing, someone said, would these examples not be, yeah, you can do 1 or 2. I'm just showing you on a 10-grand portfolio maybe how many contracts, but everybody would start at 1 contract, right? So the question said, would these examples not be as effective with 1 or 2? No. The assumption is you would start with 1 or 2, you'd start 1 contract. Somebody said, would you use a similar strategy on futures options? It depends on the futures option. But yes, it depends on, again, I like a vehicle like SPX. Why? It's a well-diversified vehicle with 500 stocks. I like Russell. Even though Russell moves faster than, is more volatile than SPX, it's made up of 2,000 stocks. Some of these, but E-minis, gold, oil can be I'm not as familiar with those, but they can be, or E-minis I am, but they could be decent. I'm not more familiar with like SPX and RUT. What about the option commissions you pay? If we are trying to make 160, we are making brokers roughly 35 first. You know, again, commissions are much more, are pretty reasonable these days, right? So if I'm trying to make, you know, let's face it, if I'm trying to make a margin of 2,000, this is a smaller trade, but if I'm trying to make a margin of 2,000, if I'm trying to make 10%, what is that a week? If I'm trying to make 10% on $2,000 of capital, what is that per week? 200. What's that a month? What's my goal per month on 2,000? What's my goal per month on 800 bucks? Right? That's a lot. That's my goal. Now, but if I'm trying to make 200 on 2,000, how much would you think is reasonable for the commissions? So if I'm making 200, which is 10%, how much do I have to give up in commissions? What's a reasonable rate these days that most people could get on commissions? What's a reasonable rate that a retail trader can expect to get on commissions? If you shop around, what's a reasonable rate? $1 a contract? Yes, not $6, $1, right? So if I make $200, 10% of that is 2,000, right? Or 10% of 2,000 is 200. Now, how much of commissions would I have to pay out of that? So if I do this trade 4 by 8 by 4 going in and 4 by 8 by 4 going out, what's my commissions? $32, right? So I paid $32. So instead of making 10%, right? Instead of making 10%, 200 divided by 2,000, right? I made about 170 divided by 2,000. That's about 8.5%. Agree? So are commissions destroying my profit? Yes or no? I went from 10 to 8.5. Are commissions destroying my profits? Absolutely not. So somebody said my projection for SPX is 2270 for about, no. My projection for SPX is I have no idea. My projection on these trades is I want to sell the at the money and get the most time decay. That's my projection. Now, in this, you're right. I'm just starting it up a little bit. The reason I started up this butterfly, and this will be something I'll get into a little more next week, good eye on this. I'm starting it, usually I do it at the money. In this case, I started it a little bit up, but you notice I'm still short deltas. So when you're doing these butterflies, because of the volatility skew in the SPX, meaning the out-of-the-money puts are higher volatility than the out-of-the-money calls, when you start them at the money, you're going to have a short delta bent to them. So to cut that down just a little bit, I started this butterfly 5 points up. So if I would have started it right at the money, 2265, and did a balanced butterfly, balanced meaning that my longs are the same distance from my shorts, I would have been probably short 12 or 13 deltas. So no opinion. All right. And then another strategy. Now, what is a reason why don't you think that I teach to sell naked options, sell short straddles or short strangles? Why do you think? Why do you think I don't teach on a regular basis selling straddles and strangles? Because it's not a good, efficient use of capital, in my opinion, right? I mean, in a portfolio margin account, it won't cost as much unless it moves against you, but it just, it just really, the name of the game is yield, right? And it just eats up a lot of capital. So unless you just have so much money, you don't know, some of you may have so much money you don't even know what to do with, right? I'm joking. Well, then you could sell strangle, but if you sell enough naked stuff, right? Sell naked straddles and strangles, and you keep doing that, and you don't have good risk management, eventually your big pile of money will get smaller, right? So I'm not saying, do I know some very good people and smart people who sell naked options? And again, it's all about the size, right? If you sell small, right? But the main reason I don't do it is just for the use of capital. That's all, efficient use of capital. But is there anything inherently bad of doing one contract or two? No, but I just don't generally teach it because I don't want students to get in a bad habit because I just think it's not a good use of capital. If you're selling something at the money, a naked call or put, go buy something against it for 20 cents, right? It'll lower your margin dramatically, right? It's just, to spend $100 to lower your margin by 10 grand, I'd do that all day, right? Strategy number 3, a calendar. Again, we're in a very low volatility environment. SPX around this level today. So here's kind of a 9-day calendar where we were at 2265. I'm selling the Jan 27 expiration that expires in a week from Friday, right? Oh, no. Oh, Jan 13 expiration that expires a week from Friday. And I'm selling the Jan 13 2265 calls, and then I go out about 14 days and buy my Jan 27s. The debit is $845, so that's $845 per contract, and so that'd be about $2,500 margin. Here are your break-evens, your expiration break-evens, where your profit line crosses zero at expiration, are about 2245 and 2285. That gives you about 20 points either way, even though those numbers can get wider if the volatility increases, right? Again, you have a nice theta, your long vega volatility, and again, this is a positive theta trade. So unlike a butterfly and an iron condor that are short vega, what this means is you're buying the options that have more time premium than the ones you're selling, right? So that's why it's a long vega trade. You're buying more time premium than you're selling, but you're getting positive theta because even though the ones you're selling, right, are smaller price than the ones you're buying, because there's less time to go, these January 13 expiration calls are going to decay quicker than the Jan 27s. So I'm looking to, if I'm looking to make 10% on this, I buy it for $845 debit, which is about an $840 trade. I'm looking to make about 80 cents on it for one contract. So I might look to sell it out at, $9.25 credit. You have an order to do that. So we're going to have a lot of fun over the next 4 weeks, delving into a lot of live trades on these and try to make you a better craftsman and work on different, give you little tips on how we structure these in different volatility and price environments, how to adjust them, how to set up a good plan. And just, the goal of the next 4 weeks is that I can get you in good enough habits so that at the end of the class, you feel a little more confident that you can continue doing this because we've been doing it for 4 weeks. So anyways, so that's it. We would love to have you in the class. Again, you could go to the front page of Sheridan Mentoring and sign up for that. We start next Wednesday at 1 Central. But anyways, thanks everybody. I appreciate you coming in today. And I'd love to see you here next Wednesday. If you have any questions, you can email me, dan@SheridanMentoring.com. And we will see you guys next week for class. All right. Thank you.